Good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, certified financial planner Kevin Zivna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls if you have a question or comment relating to your own personal financial situation or anything I'm talking about tonight. Jump on the phone lines, give me a call. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get you right on air. 627-7979. That's 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interest ahead of our own in any business dealing or recommendation that we make. And that's the way it should be when you work with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday at 6 p.m., and that's to reach out and help as many people in the Hampton Roads listening area that we can achieve your measure of financial success, because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security if they choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone. Give me a call, 627-7979. Whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies, retirement planning, retirement plans, 401ks, 403bs, TSPs, IRAs, Roth IRAs, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts. All that and more falls under the umbrella of personal finance. We are here to discuss tonight. 627-7979. And tonight, we are going to talk about creating income in retirement. Woohoo! So you finally made it. You made it over the finish line. A full and fulfilling career. Time to take a step back, maybe turn the page, start a new chapter of life, all those euphemisms. But what have you? You have reached retirement and are ready to start living off of your income and your income sources without having to necessarily work to do that. And so in many respects, this is what we would call the distribution phase of financial planning. The accumulation phase, in many respects, the accumulation phase is somewhat easier. Now, it takes sort of muscle, power, grit, determination to accumulate, but in many respects, it's easier, it's less complex, maybe I should say that, than the distribution phase and creating income in retirement. So there's a lot of moving parts to how you determine your income sources, what type of income sources you have at your disposal, the way to take that income. And so we're going to talk about a lot of that tonight and jump into some of the details. You know, it is a exciting and fun period of time. Retirement opens up a world of possibilities, a world of opportunities. But you need money, right, to sustain yourself. And it also can be a challenging time to determine how to maximize all your financial resources and your income in retirement if you want to do it right. So let's jump into some of those sections of creating retirement, income in retirement. So first of all, you got to understand kind of how much you need, right? Do you have a sense of how much you spend? What is your estimated living expenses? So, basic living expenses, housing, utilities, food, transportation, basic leisure. I'm not talking about big travel. That's kind of a separate category. But, your basic daily living expenses. Should have a decent handle on those. Trying to figure it out kind of sounds like creating a budget. I'm not going to tell you need to create a budget because you're probably not going to create a budget, and that's okay. Usually at a macro level, you can kind of put a rough number on what your monthly spending is, or maybe just your annual spending. While you're in your working years, you can take your gross income, subtract out about, let's call it, for most middle class incomes, 25% for state and federal taxes. So you're left with about 75% of your gross. And then subtract out anything you're saving, like contributing to your company-sponsored retirement plans, like 401ks, 403bs, TSPs, that sort of thing. And that whatever is left over, that's what you're spending. So there's kind of a really simple, high-level way to create a budget and get a sense of what you're spending on a monthly or annual basis for basic living expenses. But when we go into retirement, there's a couple other considerations that we have to be mindful of in our future spending plans. Number one, healthcare costs, right? Getting older, probably consuming a little bit more healthcare. So what does healthcare expenses look like in retirement? Well, we definitely have Medicare premiums, right? Got to factor those in. Those are going to come out of our Social Security payments, no matter what. Then we have, normal out-of-pocket expenses, so additional costs for healthcare that is not covered by Medicare. I will say this, however, as a practitioner who works with primarily a demographic that is either on Medicare or close to Medicare age, I can report that Medicare seems to do a pretty darn good job of picking up most healthcare expenses, and there tend not to be a lot of out-of-pocket expenses with Medicare unless you are maybe needing some experimental drugs or experimental treatments. But Medicare really does a pretty good job of paying for most healthcare expenses. But then there's the big wild card out there, and this isn't quite exactly healthcare, but it's close, and it's called long-term care. And that is the last potentially big expense that we all may face. The cost of long-term care, maybe assisted living facilities, nursing home, that type of thing. Right now in Hampton Roads, we're seeing costs for assisted living facilities at around $5,000 a month. Full-on nursing home facilities closer to $10,000 a month. So those are pretty big numbers that, at least in our practice, we're always planning for, or we at least have on our clients' radar. And it's, it is very difficult to plan for. There's a wide range of potential outcomes when it comes to the cost of long-term care. Obviously, if you end up in a facility where full-on nursing home care costs are needed, then you could be looking at about $120,000 a year times maybe 4 or 5 of the average stay in a long-term nursing home facility, then almost $500,000, and that's just in today's dollars. And that the cost of that care is rising faster than inflation, at least right now. So if you're just at retirement age, call it 65, 30 years into the future, it's going to be even more expensive than that. But it also could be zero as well. So a wide range of potential outcomes when it comes to healthcare costs, something you need to consider when you start trying to figure how much income you're going to need in retirement. And then there's another one that almost everyone forgets about until it rears its ugly head, and that is inflation. And inflation erodes purchasing power over time. So the dollars you have today, whatever they are going to be worth less next year, and then the year after that, and the year after that. And as long as inflation is modest, between 1 and 3, maybe I'll even go up to 4%. On average, if inflation is modest, then that's normal and healthy for an economy, but still a factor in the fact that the money that's sitting in the bank account is almost always earning less than the prevailing inflation rates. So the money just sitting in traditional savings, traditional checking accounts of most banks is actually becoming worth less a little bit each year due to the effects of inflation. So what you need in income today is going to require what you can purchase in goods and services today with your dollars is going to require more dollars next year, 5 years from now, 10 years from now, 20 years from now, and on ad infinitum because of the effects of inflation. So your money, your income sources, has to try to keep pace with that if you want to maintain your standard of living, which most people want to maintain their standard of living in retirement. I'm going to get into a little bit more on how to determine your income needs and setting some goals in the first segment of creating income in retirement. If you want to jump in on the conversation, 627-7979. I'm Certified Financial Planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm Certified Financial Planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. All right, tonight we're talking about creating income in retirement. And first part was I was talking about understanding various retirement income needs, assessing your financial needs, not just the wants yet, the needs. What do you need to keep the lights on, food in the refrigerator, gas in the car, your health care needs met, and then you got to keep an eye on that pesky inflation that is always chipping away at the value of your dollar. All right, before I move on, got a caller on the line. If you got a question or comment relating to your own personal financial situation, 627-7979. Right now, we're going to go out to Virginia Beach and speak with Brad. Good evening, Brad. You're on Dollars and Common Sense.
Hi, good evening. I have a Roth IRA and an IRA, and my adult child will inherit those both. And I've told him, as far as the IRA goes, chip away at it over 10 years so that you don't get eaten up in taxes. But what are the rules with the Roth IRA? Does he have to take RMDs every year, or can he just wait at the end of 10 years and then take it out in lump sum? I can't figure it out.
Yeah, well,
it's confusing.
Yeah, well, you're pretty good that you're up to speed, Brad, with the new rules. Required minimum distributions of inherited IRAs used to be allowed to be stretched out over the life expectancy of the person who inherited that traditional IRA, but now that's been reduced to 10 years. So the same is with the Roth, although it doesn't. And so the reason you want to stretch out an inherited IRA over an extended period of time, over someone's lifetime, is because you don't have to take out as much from it each year, and therefore less of it is subject to income tax. When now under the new rules where inherited IRAs must be taken out over a 10-year period, sometimes 5 in other situations, but I won't get into that. But over a 10-year period, that's going to force more money out of that inherited IRA over a shorter period of time, and can potentially and most likely run you up the tax ladder, we call it, and subject those distributions to higher income tax rates. So it's ultimately a way for the government to get more tax dollars out of those inherited IRAs. So now to your particular question, the Roth IRAs, basically under the same requirements. It needs to be taken out over a 10-year period, but in almost all cases, all the money that comes out of a Roth IRA is not subject to taxation. So whether you take it all out in one lump sum on the day you get it from inheritance, or you stretch it out over that 10-year period in equal installments, or you wait until the last day of those 10-year period, it doesn't matter because none of it is taxable, but it does have to come out over 10 years.
Okay, so he can wait for 10 years, let it max out tax-free over that 10-year period, and then as long as he pulls it all out by the end of year 10, he's good.
Yes, and that's the general recommendation in most cases at this point for the distribution rules as we know them. They have been changing somewhat, but yes, allow it to grow tax deferred, essentially tax-free, but allow it to grow tax-free for 10 years and then take it all out in one big lump sum before that 10 years is up. And that's how you can kind of maximize the growth out of the Roth IRA. Because once you take it out, then it's outside of its tax-protected Roth wrapper, and then it can get subject to taxation. And you could avoid that by just keeping it in the Roth.
Well, thank you for clearing that up for me.
All right, Brad, thanks for the question. That was a good one. I appreciate it. 627-7979. All right, back to creating income in retirement. All right, so you got your needs that you got to be mindful of. Now, how about your wants in retirement? What do you want to spend? What do you want your lifestyle to be like in retirement? I mean, you've been working your whole life for this, right? Socking money away, living below your means, sacrificing along the way, delaying gratification. Well, here you are. You have retirement. Let's not delay anymore. Let's start spending. Let's live life. Let's do the things that we put off doing. Let's travel. Let's buy the boat. Let's get the vacation home. And so that's part of determining your desired lifestyle. There's, of course, traditional travel, maybe around the U.S. For a week here, a week there. But a lot of people tend to take this opportunity to start international travel. We encourage our clients if they're taking the big trip of a lifetime, then you do it upright. You sit first class on that trip to, London or Paris or Dubai or wherever you want to go. You take those first class seats. You stay in that luxury hotel. This is a trip of a lifetime that you've been waiting to take to wherever you want to go. You do it right. You've earned assuming you did your financial planning properly, you've earned the right and the privilege to now do it that way. So you got traditional travel. You've got what we call kind of glam travel or some international travel. What about those? We got some clients who bought a recreational vehicle, an RV, and are traveling around the U.S. in an RV. You know what an RV costs? If you get one of the good ones, top of the lines, with the TVs you got underneath and the coolers in there, and you got a couple showers and the kickouts on the side, you're looking at $800,000 to $1 million for an RV. How about a boat? Now that I've got a lot of time, I'm finally going to get that boat that I always wanted. I never had time for. Okay, well, those can run the gamut from maybe $25,000 fishing boat, and of course the sky's the limit on a yacht. Family experiences. That's one thing we encourage a lot of our clients to do. Mom and dad, newly retired, now have an extended family with adult children, grandkids, maybe even some great-grandkids. They often say when we have when we don't have clear goals on where they'd like to travel, then we usually say, why don't you just go someplace and take your entire extended family? So get one of those big monstrous houses at the Outer Banks for a week or two, and you pay for everything for everyone and make memories. Those memories will last your family a lifetime, and they will endure after you're gone, and your adult children and their children and your great-grandchildren will remember the time that grandma and grandpa, took us down there and we played and had so much fun on the beach and so on. Family experience. Take everybody on a cruise. Maybe you want to take a cruise somewhere. Spring for the entire family. Vacation home, maybe the time now to get a vacation home because you more time on your hands. Maybe it does make sense to go to that favorite place that you like to always visit and maybe spend months at instead of just a week here and a week there. And then, of course, you have family gifts. Retirement, good time to maybe start giving away some of your money to your kids, charitable donations. We can start being more generous to the charities that we want to support. And then you have to be careful because once you're in retirement, every day is Saturday. And so you got to be careful. There's a lot of spending that happens on Saturday. All right, I got to take a break for the news that's coming up. David, Virginia Beach, I see you. If you're still there after the break, we'll get you on air. 627-7979. I'm certified financial planner Kevin Zibna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zibna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for, is just to send you the information that you request. Or if you got some nuanced questions, want to speak to a live human being, we got those too. Give us a call at the office, 757-456-2200. Want to remind everybody, our next live show will be in 2 weeks on Tuesday, October 8th at 6 p.m. as usual. But if you can't catch us live every second and fourth Tuesday of the month, get this show as a podcast. Search for Dollars and Common Sense wherever you get your podcasts. Download us and take us with you wherever you go. Listen at your convenience. And for those of you into social media, we have a presence on Facebook and LinkedIn. Search for Dollars and Common Sense, hit that like or follow button, and then usually once every week or two we put up an interesting and informative financial planning post. All right, tonight we're talking about creating income in retirement, and I can already tell I am not going to get through the entire material that I have for this show. As I said at the outset, creating income in retirement is much more complex than the accumulation phase, the saving phase, investing phase. Trying to determine how much income you need and where to take that income from and how to take that income is more complex. But it's also the fun part. Before I get into any more of that, though, going to run out to Virginia Beach again, speak to David. Good evening, David. You're on Dollars and Common Sense.
How you doing, Kevin? The reason I'm calling, just curious what your thoughts are on the general rule about a 4% withdrawal rate. I know it's a little more complicated than just a yes or no, but I've read reports where it's not the thing to do anymore, but I just wanted to see what you thought about it.
Mm-hmm. Okay, great question, and it was definitely on my list to discuss here as part of this show. So, yeah, once you get an idea of how much income you need, then you got to start determining how much you can take and where you can take it from your various income sources. One of those sources is your investments. we and other financial advisors like us spend a lot of time and attention helping people build investment portfolios designed to grow their assets faster than the rate of inflation over time. That's called building net worth or building wealth. But then the time comes to eventually flip the switch. And instead of adding to your investment portfolio, you no longer have to do that. And you're going to start taking from your investment portfolio. So how much can I take from my investment portfolio? Well, what David is alluding to is I think you called it the 4%. It's really
withdrawal
not
rate.
Yeah, 4% withdrawal rate, but it's not really a rule, and it gets misconstrued as a hard and fast rule. The 4% rule in quotes is from a well-managed, properly diversified, growth-oriented investment portfolio. There's a lot of qualifiers there. One can withdraw approximately 4% of the initial portfolio's value in year one that you start taking your withdrawals, and increase that, whatever dollar amount 4% equates to, increase that amount by a reasonable amount of inflation, so call it 3% each year, so that the withdrawals maintain their purchasing power over time. And then there is a high probability that that withdrawal rate is sustainable for at least 30 years, which for most people is probably about a good number of years in retirement. So the 4%. So, for example, on $1 million portfolio, a $1 million well-managed, properly diversified, growth-oriented investment portfolio of $1 million, someone could reasonably expect to pull $40,000 a year before tax now. And then if it's from traditional IRAs, you have to pay the taxes and then you can spend the net. So $40,000 for each $1 million of investable assets. I think that's a good ballpark number, and that's kind of how we treat it and how we talk about it. It gets you in the ballpark, but it's something that really so you can sort of estimate based on your level of investments that you have how much you could reasonably expect to spend from that portfolio, and the money will last your lifetime. So it gets us in the ballpark. I like it as a rule of thumb, but obviously we put a very fine point on our withdrawal strategies, and we are constantly updating and reevaluating every time we get to our clients whether their withdrawal rate is sustainable or not. So did that help you out, David?
Yeah, that's a good answer. All right, thank you.
All right,
Good work.
thanks for the question. I appreciate it because a lot of people the 4% rule is starting to infiltrate its way into down to the layman terms, where for years it was sort of industry speak. But it is a rough rule of thumb to determine how much you can spend from your investable assets if, again, they are well managed, properly diversified, and growth oriented. Okay, so calculating retirement income. We were talking about setting financial goals. What type of lifestyle do you want to live in retirement? And for a lot of people, it's time to start spending more than maybe they were pre-retirement because of all the travel opportunities and leisure opportunities that they have at their disposal, and the fact that they're getting older and they want to see some of their hard-earned money maybe be shared with other family members, charities, and that type of thing. So it's quite possible that your lifestyle could increase when you go into retirement. And I should say, so we use the term lifestyle interchangeably with how much with your expenses, right? So how much you are spending either on a monthly or annual basis is your lifestyle. That's the level that you're living your life. And for most people, they generally say, they ask, when they come to us or through the planning process, can I maintain my lifestyle? Can I do what I'm doing today? Can I purchase the same level of goods and services that I am today without having a job, right? In retirement, do I have enough income? So that's usually a starting place for us when we go through the planning process to say, can you sustain your lifestyle at this level, yes or no? And then we make adjustments. If it looks like no, you're going to have to take a step back. That's when, well, maybe we work another year or two and plow a bunch of money into our company retirement savings plan. Or maybe we get a part-time job to supplement income. A lot of people like to do that nowadays. And then, of course, there are those situations where you work with us long enough. Usually we're getting people to the point where, look, we're telling you, you don't have to work for income purposes anymore. You have enough income sources at your disposal that you are now working because you want to work, not because you need to work. And surprisingly, a lot of people tend to want to do that until some other event in their life creeps up to let them know it's maybe time to take a step back out of the workforce, or maybe just redirect in the workforce. But just because you have enough money to not work doesn't mean you have to stop work, and most people we have found don't. All right, I'm going to pause for the last break here. Then I'm going to do a kind of a deep dive on Social Security, the main source of income for pretty much all of us in the United States. And then this will just be part one of creating income in retirement. I'm definitely going to have a part two. We'll do that at our next show on Tuesday, October 8th. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. All right, talk about creating income in retirement tonight. We're not going to get through the whole program, so there's going to be part two next show. So far, we've got through understanding retirement income needs. Now we want to jump into some of the sources of retirement income. Well, Social Security is the big one, and pretty much available to all of us who have reasonable work histories, or who are the spouse of somebody who has reasonable work histories. And yes, it's going to be there. You can still depend on it. And it is true that there is potential for a reduction in about beginning in about 10-ish years or so. I doubt that will happen. I think as the time grows closer, that will be the pressure that it will take Congress to make some changes to the program in order to sustain its viability. So, Social Security available for almost all of us, the retirement portion of Social Security. So, how much Social Security are you going to get? Right? The range of Social Security retirement benefits varies based on the age at which you start claiming them. And you can claim them, most people, there are some exceptions, as early as age 62. And the current maximum benefit that someone could receive at age 62 is $2,710. So approximately $2,700 is the maximum amount of Social Security benefit that someone could claim if they're eligible. How do I get the maximum benefit? Well, you have to make a lot of money for a lot of years. There's the calculation on how much you are eligible for, which by now, for a while there, they were sending us a statement like your bank statement or your 401k statement, except they were sending it once a year. Well, now it's all online. And so if you just go to ssa.gov and you set up an account, then any time you want, any day of the week and any time of day, you can go online at ssa.gov and find out what your benefit is projected to be. That benefit is based on your work history, how long you have worked, and how much money you have made over those working years. So if you have made throughout your career close to the maximum Social Security wage base, then you will be entitled to the maximum Social Security benefit. And again, at age 62, that's about $2,700. Now, at what Social Security calls the full retirement age, which right now is about, depending on when you were born, your full retirement age is going to be between age 66 and 67. So it could be 66 in 2 months, 66 in 4 months and 3 days, or 67. But anyway, between 66 and 67, full retirement age, that maximum benefit is $3,822 a month. And then you don't have to take Social Security at your full retirement age. That's somewhat of a misnomer, full retirement age. It has some distinguishing characteristics that come into play with other claiming strategies, but you don't have to you don't have to claim Social Security at what Social Security deems your full retirement age. You can wait until age 70. And every month, really, that you wait, beginning at age 62, your Social Security benefit increases somewhat. In fact, about 8% per year that you delay claiming beginning at age 62, all the way up to age 70. After age 70, there's really no benefit to waiting not to claim after 70. You should claim at 70. So the maximum benefit right now for people who worked a lot of years, made a lot of money, is $4,873. So we're almost at $5,000 a month now for the maximum Social Security benefit. However, you might be interested to know that the average monthly benefit of all retired workers who are entitled to a benefit is only approximately $1,900 a month. So if you are around the average income earner and you choose to take Social Security at full retirement age or lower, then those are the people who tend to get close to that average $1,900 a month, and that is not sustainable for too many people on its own. You're going to have to supplement that Social Security benefit with other sources. And, to that end, it's interesting to note that about the most popular age to take benefits, Social Security benefits, age 62. As soon as most people are eligible, that's when they're claiming Social Security. 30% of eligible beneficiaries claim at age 62, and then 60% of people claim sometime before their full retirement age, that age 66, 67. So you got 60% of the population that is taking Social Security, what would be sort of classified as early. 60%. And then a bunch of people take it at their full retirement age, and then some people take it in that gap from full retirement age to 70. But only about 10% of the population waits until age 70 to get the largest Social Security benefit. And if you want to know how to maximize your Social Security benefit over your lifetime, well, that can be rather complex. There's a lot of factors in play there. But a lot of it has to do with your longevity, no matter what age you decide. But if you want to maximize it, wait till age 70 and then live a really long time. Stay healthy, eat right, exercise, and you can stick it to Social Security by waiting to 70 and outliving your life expectancy. A note about working while receiving Social Security income. So if you are under those full retirement ages of 66, 67, and you claim Social Security, then your benefit will be reduced if you also earn income. Basically, if you still work. If you claim early, before full retirement age and you work, your Social Security benefit is going to be reduced. How much? It's going to be reduced $1 for every $2 you earn above the annual limit, which right now is about $22,000. So it's real easy to exceed that in even a part-time job. So we rarely recommend people claim Social Security early if they're going to continue, if they know they're going to continue work or they think they're going to continue to work, because you're just going to have that Social Security benefit reduced in most cases. Now, I will say that any benefits that get withheld before reaching full retirement age due to these excess earnings, your benefit will get recalculated and it gets credited back to you. So eventually, you do kind of get that money back, but it's an administrative hassle, tax forms, and why you're claiming now when you're working anyway. It usually just is not a good decision. And then once you reach though full retirement age, then there is no reduction in the benefits for Social Security. Regardless of how much you earn. So if you want to keep working, say to 70 or 75 or 80, you can, and you can still claim Social Security at full retirement age without any reduction. So that is usually where we recommend it makes sense for people to start thinking about it. And for those of you who retire early by choice and on purpose and have the means where you don't need Social Security income, that then brings into play a couple of different factors. Well, you don't need the Social Security income, say you have enough investments to live off of for a while. When do you kind of claim Social Security? Well, the math would say wait, let the benefit accumulate, assuming you're healthy and have reasonable life expectancy probabilities. Let the benefit build, and that's how you're going to get the biggest bang for the buck. But we also know in our practice from professional experience that a lot of times when people get to their late 80s and early 90s, no matter how much money they have, they aren't spending a whole lot of it because they just don't want to typically. They aren't as mobile, and it's just harder to get around. So what good is that extra money of Social Security later in life when you're not really going to use it? It might be more beneficial, most probably more beneficial, in your early 60s to take it, even though you don't need it, because you can use it while you're relatively young and healthy. And that might be a good time to take the big trips, make the big gifts, buy the big boat, do all those things with that extra money, even though you don't need it. And you're not trying to maximize Social Security's benefit. You're trying to use that money to maximize your quality of life when you have good quality of life. So that's not a math calculation. It's not a financial calculation. That's a quality of life and lifestyle calculation or thought process. And that's really what we do this financial planning for. All right. I'm out of time for tonight. I'm going to be back in 2 weeks on Tuesday, October 8th at 6 p.m. as usual with more on creating income in retirement. I'm certified financial planner Kevin Zivna. You've been listening to Dollars and Common Sense on News Talk 790 WNIS. The preceding program was sponsored and paid for by Wealthway Financial Advisors. We are solely responsible for its content.